13,420 homes on the market, and a new year that refuses to blink. In New Jersey, the numbers are steady enough to soothe and jagged enough to sting. Start with the ground under our feet. As January opened, the national housing engine sputtered and steadied at the same time. Active listings across the country fell below 1 million for the second straight month, even as they climbed 10% year over year. That's the paradox. More choices than a year ago, yet still 17.2% fewer than before the pandemic reset the map. New listings trickled in, up 0.7% compared with last January, and surged seasonally by 41% compared with December. Buyers had a little more to look at, and they took a little longer to decide. Listings typically sat about 78 days, 5 days longer than the year before. Prices at the national level held their breath. A median listing price of $399,900, unchanged from a year earlier. 14.3% of listings cut their price to move. Now, zoom in to New Jersey. The Garden State entered January with 13,420 active listings. That's 11.67% higher than a year ago and 6.38% lower than December's holiday shadow. Of those, 6,348 were newly listed in January. The statewide median listing price landed at $519,999, down 2.8% year over year and down 1.76% from December. Sellers still pulled some levers. 1,484 price reductions appeared in the month, 6.85% fewer than a year ago and 9.85% fewer than December. And buyers took their time. Statewide, listings lingered for 60 days. Accompanying the inventory freeze-thaw was a soft dip in borrowing costs, but not enough to redefine affordability. In January, the 30-year fixed rate ranged from 6.06% to 6.16%. 15-year loans hovered between 5.38% and 5.49%. That's lower than the peaks buyers still remember, but close enough to recent months to keep calculations cautious. In this market, geography is destiny, and North Jersey tells the clearest story. January split the map in two directions. New listings grew year over year in Passaic, Sussex, and Hudson counties, and fell in Bergen, Morris, and Essex. The counts themselves cut through the fog. Passaic launched 230 new listings, up 20.83% from a year earlier. Sussex brought 156 to market, up 21.88%. Hudson posted 388, a 22.01% jump. On the other side of the ledger, Bergen saw 540 new listings, down 1.82% from last January. Morris listed 288, down 6.49%. Essex added 324, a 2.41% decline. Days on market made the contrasts sharper. Bergen and Morris were the outliers, speeding up a hair. Bergen's typical listing sat 53 days, 1.87% faster than a year prior, and Morris came in at 47 days, 3.09% faster. Elsewhere in North Jersey, the clock ran longer. Passaic listings averaged 46 days, up 12.2% from last January. Essex stayed flat at 52 days. Sussex reached 68 days, up 18.26%. Hudson hit 59, up 10.8%. Prices tell their own version of the same split. Of the 6 North Jersey counties, only Passaic posted a year-over-year gain in the January median listing price. Passaic's midpoint rose to $549,000, up 8.44% from a year earlier. Everywhere else edged down. Bergen's median hit $777,000, down 1.05% year over year. Morris landed at $675,000, down 1.46%. Essex came in at $549,900, off 0.56%. Sussex listed at $399,950, down 3.33%. Hudson marked $599,000, off 1.96%. Even with that cooling, price cuts didn't explode. In January, Bergen recorded 108 listings with reductions, the same as a year prior. Passaic tallied 28 reductions, down 17.65%. Morris posted 48, off 4%. Essex counted 64, up 23.08%. Sussex reached 40, up 17.65%. Hudson marked 88, up 18.92%. Taken together, the signals suggest a market still negotiating the margin. Buyers getting more time, sellers watching closely and trimming when needed. But averages don't sell houses. Lived experience does. In West Orange, a full-year snapshot from 2025 captures the heat beneath the January frost. The township closed 389 home sales in 2025, a 1.8% increase from the prior year. The average list price rose to $673,551. The average sold price cracked a new ceiling at $732,623. On average, buyers paid 8.8% over the asking price, slightly lower than the 9.1% average premium in 2024, but still an extraordinary tilt. Days on market dipped by 1.3 days. 47 homes crossed the $1 million threshold, 12% of all sales. The highest sale touched $3,200,000. At the extremes, one address listed in the $700,000 range sold for more than $1 million, about 151% of asking, while another home moved at 83% of list. And the texture of competition was clear. In 2025, 80.5% of West Orange listings sold over asking, 8.5% at asking, and 11% below asking. Those are numbers you can feel. They show up in open houses where buyers hover by the staircase, calculating offers in real time. They echo when a contract closes in 5 days or a week stretches to 6. They magnify in a market where one town's average over-ask eclipses 8%, while a neighboring county tallies more price reductions. They tell you where demand has stacked up and where fatigue has begun to register, one carefully placed cut at a time. Across New Jersey, a second storyline runs in parallel. High-end values are still finding new ledges to climb. Look at the coastal and commuter crescents in the 12 months ending December. Deal led the entire state with a typical home value of $4,127,662, up by $339,174 in 1 year, about a 9% bump. Alpine climbed to $2,981,806, up $286,361, 10.6% higher. Loch Arbor reached $2,880,330, rising by $242,040, $6, about 9.2%. Saddle River stood at $2,183,701, posting a 1-year increase of $207,827, 10.5%. Bayhead reached $2,322,964, up $174,477, 8.1%. Seagirt ticked up to $2,275,343, adding $172,462, 8.2%. Demarest rose to $1,388,103, climbing by $156,620, 12.7%. Franklin Lakes hit $1,526,030, $2, up $145,864, 10.6%. Manteloking reached $1,960,573, up $138,872, 7.6%. Summit marked $1,311,256, up $105,697, 8.8%. Even beyond the top tier, towns like Montclair rose to $1,081,750, up $61,844 in 1 year, 6.1%. Maplewood moved to $899,232, up $62,974, 7.5%. Livingston ticked to $1,247,960, $26,961, up $53,726, 5.5%. In town after town, the dollar changes weren't abstractions. They were six-figure redefinitions of what it costs to plant your life within an hour of Midtown. But not every scene is shot from a waterfront balcony. The median statewide listing price in January was $519,999, down 2.8% from last year. Bergen's median listed at $777,000, nudged down 1.05% year over year. Essex stood at $549,900, down 0.56%. Sussex sat at $399,950, off 3.33%. These are the middle lanes of the market. They carry the families who shop school districts, the buyers who build spreadsheets to the dollar, and the sellers who stage a third bedroom to look like a home office, because for many, it is. Why this split? Signals suggest it comes from three directions. First, supply is tight, but stuttering. National inventory has been rising year over year for 27 consecutive months, yet it remains 17.2% below pre-pandemic norms. In New Jersey, active listings rose 11.67% year over year in January, but fell 6.38% from December. Second, borrowing costs 6.06 to 6.16% for a 30-year fixed, 5.38 to 5.49% for a 15-year dial affordability up and down in step with buyer confidence. Finally, the broader playbook for developers and investors is cloudy. Across the industry, uncertainty swirls around tariffs, a federal tax bill, interest rate paths, and immigration trends. It delays decisions. It drags timelines. It puts a finger on the scale when the scales are already sensitive. That fog isn't just poetic, it's operational. Construction costs have logged significant year-over-year increases. Lead times for critical gear, like switchgear and transformers, stretch project schedules. When a building waits months for parts you can't see behind the drywall, the ground-level impact shows up in the pipeline. Deals get pushed, lease-ups start later. Supply that might balance a market one quarter spills into the next. And yet, through that fog, certain lights are bright enough to navigate by. Jersey City ranks among the very top markets to watch, landing second on a national list. North Jersey as a whole sits seventh. Those aren't trophies, they are tells. They reflect where attention, capital, and renters are landing. Lease-ups in Jersey City have surged as high as 80 to 100 units a month in some new buildings. That's not a footnote. That's velocity you can't fake. It's demand finding the door, the elevator, and the mailroom all at once. Developers are placing chips with intent. One firm alone is advancing 3 transit-oriented developments in North Jersey, representing $900 million in development value. Flagship projects span East Orange, where the crossing at Brick Station is rising, and New Brunswick, where 90 Bayard Street is taking shape. In New Brunswick, the job anchors Robert Wood Johnson's hospital system, Johnson & Johnson, Rutgers University, are being joined by a new hub called Helix, where hundreds of jobs are being created. Signals suggest that when employment bases of that scale cluster, multifamily supply that lags can create a clean mismatch between demand and what's available. That imbalance is what developers chase and what renters eventually correct, one leased unit at a time. Commercial capital is testing its footing. One capital markets team counted 91 closings last year in this region, representing $4.40 billion in transaction volume. Nearly 20 of those deals were in office, some destined for repositioning, some teardowns, and some set to remain office. The texture of that activity matters. Assets where owners invested fresh capital have seen leasing pickup and even slight rental increases. Not a victory lap, but movement back toward occupancy. On the financing side, private lenders are bidding again. One refinance recently drew dozens of bids before closing with a well-known investment group. The line that many in development watch, cap rates versus stabilized debt costs, has begun in some cases to invert the stress of the past few years. When cap rates exceed debt costs, the math starts to pencil. That's when limited partners, the LP equity that fuels vertical development, steps back into the frame. But uncertainty hasn't vanished. A shift from Opportunity Zone 1.0 to 2.0, under a package called the One Big Beautiful Bill Act, has many investment groups pausing. Those with current opportunities are unsure how the transition plays. Those seeking to raise new capital under 2.0 appear, in many cases, to be waiting for guidance expected later this year. It's a bureaucratic tick with a real-world tail, projects delayed by paperwork, not by lack of need. In the rental tower, casting long shadows across a Hudson River sunrise, apartments can lease at $100 a month. In a Cape Cod on a Sussex cul-de-sac, the days on market stretch past 60. In Montclair, the typical home moved up by $61,844 in 1 year to $1,082,750. In Maplewood, the rise was $62,974 to $899,232. In Short Hills, prices reached $2,202,226 with a 12-month climb of $120,563. In Allenhurst, $2,185,102,009 and up by $166,804. In Seagirt, $2,275,343 and up by $172,462. In Deal, a 9% jump adds $339,174 in 12 months, resetting the horizon for anyone trying to catch it. Even the commuter towns beyond the postcard views have written new definitions. Westfield's typical value rose $63,307 in a year to $1,208,422. South Orange jumped $80,512 to $1,035,189. Summit added $105,697 to reach $1,311,256. Franklin Lakes gained $145,864 to $1,526,032. Demarest added $156,620 to $1,388,103. Saddle River's one-year change, $207,827, pushed its typical home to $2,183,701. Numbers like those ripple across dinner tables, school enrollments, and retirement timelines. Back on the listing screens, county-level gauges help separate heat from haze. In January, Bergen's median listing price of $777,000 was down 1.05% from last year, but up 1.87% from December. Passaic held at $549,000, up 8.44% year over year, and down 0.16% month over month. Morris, at $675,000, was down 1.46% year over year and down 2.1% month over month. Essex, at $549,900, was off 0.56% year over year and down 4.98% from December. Sussex, at $399,950, was off 3.33% year over year and down 4.08% month to month. Hudson, at $599,000, was off 1.96% year over year and down 0.08% from December. On market pace, January's clocks tick different in each county. Bergen, at 53 days, 1.87% faster than a year ago. Passaic, at 46 days, 12.2% slower. Morris, at 47 days, 3.09% faster. Essex, at 52 days, unchanged. Sussex, at 68, 18.26% slower. Hudson, at 59, 10.8% slower. For a buyer, those variations change everything. A fast Bergen or Morris week demands pre-approval sharpened to the penny. A slower Sussex month offers room to negotiate, to ask for seller concessions, to include an inspection timeline that doesn't feel like a sprint. And then there's price discipline, the hidden pulse of a market. In January, statewide price reductions totaled 1,484, 6.85% fewer than last year, and 9.85% fewer than December. In North Jersey, those cuts split like the rest of the board. Bergen sat at 108 reductions, flat year over year. Passaic posted 28, down 17.65%. Morris hit 48, down 4%. Essex reached 64, up 23.08%. Sussex marked 40, up 17.65%. Hudson posted 88, up 18.92%. Where cuts rose, sellers were chasing buyers. Where they fell, pricing stayed tight. While this is the residential canvas, the commercial side feeds the same ecosystem. Office isn't dead in North Jersey. It's being sorted. Nearly 20 office deals closed in the region last year, within a $4.40 billion stack of transactions. Some assets are being repositioned, some raised, and some simply improved to keep tenants who now expect more. Where owners put real capital back in, leasing has picked up and even clocked slight rent increases. That isn't a return to 2019. It's a path back to full occupancy, warned by new habits and rewarded by better buildings. Investors are hunting for edge, and policy is putting thumbtacks on the map. Programs like Aspire and HMFA support affordable and mixed-income development, especially in transit-rich corridors. Employers and renters are following the affordability rail from Manhattan into New Jersey's nodes: Jersey City, Hoboken, Newark, East Orange, New Brunswick, places where the platform meets the platform. Train to office, office to housing, housing to grocery. The state's urban cores, led by Jersey City's second place standing among markets to watch, have merged location with velocity. Lease-ups at 80 to 100 units a month are the metric that matters when the calendar flips from draw schedules to occupancy certificates. At the same time, the invisible line items, the tariffs, the federal tax bill in play, immigration flows shaping labor markets, have created a year described by many as a decelerated timeline. When a cycle doesn't land in 2025, it doesn't vanish, it stretches. That's what 2026 looks like so far, stretched but intact. Within that stretch, there are people making the system move faster. Some firms have boiled construction down into a technology stack, using proprietary software to flag high-probability acquisitions and compress build cycles. One outfit based in Franklin Lakes is running more than $100 million in projects and claims it can trim typical 12-month timelines down to 7. That 5-month delta matters when interest accrues by the day and demand doesn't wait. On the brokerage side, the top tier has stacked up credentials, but the key figure is velocity. High-end homes once stuck in limbo have been repositioned and sold for 6 figures above prior list prices. Across Bergen and Hudson, agents with decades in the trench are using virtual staging and AI-driven targeting to pull qualified buyers into waterfront listings. Fort Lee to Cliffside Park, sometimes wrapping a full cycle in 24 days. In a market built on inches, shaving weeks can remake an outcome. Now, let's tie the chain together. What happened is clear. Inventory rose year over year but fell month to month. Statewide median listing prices slipped, days on market lengthened, rate relief was marginal. Why it happened connects to scarcity, still shadowing pre-pandemic supply, affordability toggled by 6% mortgages, and a macro environment dulling conviction. Who is affected is everyone, but in different ways. In Bergen and Morris, the faster pace means buyers still face tight windows, and sellers hold leverage if they price close to the market. In Passaic, Essex, Hudson, and Sussex, longer timelines and higher counts of price reductions suggest buyers have regained at least some negotiating room. In coastal enclaves and upper-tier suburbs, Deal, Alpine, Saddle River, Seagirt, Bay Head, one-year gains measured in 6 figures say the affluent are still reaching past the ordinary ceiling. In West Orange, where 80.5% of homes sold over asking in 2025 and the average sales price hit $732,623, bidding culture remains alive, but price sensitivity is creeping in at the margins. For developers and lenders, the picture is neither freeze nor frenzy. It's a disciplined thaw. $4.40 billion in regional closings last year, dozens of bids on a single refinance, lease-ups at 80 to 100 units per month in Jersey City, and a $900 million transit-oriented pipeline pushing into East Orange and New Brunswick. What's next is the question that holds all the others. The base case for the next 2 quarters in New Jersey looks like this: a slower, more stable grind. Statewide active listings should continue to show year-over-year gains off a still low base, with month-to-month slips and rebounds as seasonality and caution trade places. Median listing prices may drift within a narrow band, Passaic-like outliers rising on local demand, Bergen to Essex medians cycling slightly down or flat, while days on market remain closer to 60 than to 40. Price reduction should stay measured if sellers keep starting near reality. Statewide cuts counted 1,484 in January, and a figure in that neighborhood marks balance rather than panic. 30-year mortgage rates oscillating between 6.06 and 6.16% keep affordability tight but navigable. 15-year rates between 5.38 and 5.49 offer a lever to the well-qualified. Two watch items could tilt that base case. First, capital clarity. If the transition from Opportunity Zone 1.0 to 2.0 receives concrete guidance before year-end, groups holding cash on the sidelines may release it. That would pull multifamily and mixed-use projects forward, and in nodes like East Orange and New Brunswick, already tied to a $900 million pipeline, the effect would be visible by the fourth quarter. The same holds if lender liquidity stays thick, with cap rates exceeding stabilized debt costs. More bids like the dozens that chased a recent refinance would mean more shovels in the ground by summer. Second, supply friction. Significant increases in construction costs and long lead times for equipment like switchgear or transformers may keep calendar math stubborn. If those constraints persist into the third quarter, deliveries slip and the relief valve for rents and sale prices tightens again. In Jersey City, watch whether lease-up paces sustain at 80 to 100 units a month. If absorption slows, incentives will surface. If it doesn't, demand is outrunning the turnstiles. A third, quieter watchpoint sits in county detail. In January, only Passaic posted a year-over-year increase in the median listing price among North Jersey's 6 counties, up 8.44% to $549,000. If Bergen's $777,000 median continues to hover near flat, and Essex's $549,900 holds within a half-point drift, look not for a correction, but for a negotiation. More counters, longer inspection timelines, smaller over-ask premiums. In Sussex, if days on market keep hanging around 68, up 18.26% from last year, buyers will read it as permission to ask. Sellers should read it as instruction to price tight from day one. Underneath all of it is the human pace of a New Jersey move. A seller in West Orange lists at $865,000 and closes at $1,178,000, 36% over asking, $313,000 more than the list for one of the year's standout results. A neighbor lists in the $700,000 range and crosses the $1 million mark, 151% of the asking price. Across town, someone else closes at 83% of list. These aren't contradictions, they're segments. They're proof that this market doesn't move in one piece. It moves as a mosaic, one block at a time, one bias at a time, one bid at a time. So, when you hear that the national median list price is $399,900 and unchanged, or that active listings nationwide are 10% higher than a year ago, but 17.2% lower than before the pandemic, remember how those averages land in this state. Remember that in January, New Jersey's median listing price was $519,990, down 2.8% year over year. That listing statewide sat for 60 days. That 1,484 price cuts surfaced. That Bergen posted 540 new listings, Passaic 232, Morris 288, Essex 324, Sussex 156, and Hudson 388. Remember that a single tower in Jersey City can lease 80 to 100 apartments in a month, while a colonial on a quiet Essex street might take 52 days with no change from last year. That is the texture of 2026 so far. The fog hasn't lifted, but the beams are bright enough to steer by. Focus on the counties where new listings are rising. Passaic up 20.83%, Sussex up 21.88%, Hudson up 22.01%. Map your budget against the counties where days on market are stretching. Passaic up 12.2% to 46 days, Sussex up 18.26 to 68 days, Hudson up 10.8% to 59 days, and the ones that are holding speed, Bergen at 53, down 1.87%, Morris at 47, down 3.09%. Decide whether you want to chase a deal-like climb of $339,174 in 1 year, or a Maplewood-like rise of $62,974. Decide whether your certainty is worth the premium in a town where 80.5% sold over asking last year, or whether your patience is worth the discount in a county where price reductions climbed by double digits. In a market built on inches, the inches are visible. They're sitting right there in the data. And they point to a New Jersey that is not overheated, not freezing, but breathing, sometimes shallowly, sometimes with a long exhale, in the narrow space between caution and conviction. If you want clear, numbers-first storytelling on New Jersey real estate all year, stay with us for the next deep dive.